The broadcast is now starting. Attendees are in listen-only mode.
Well, greetings everybody, and welcome to our October edition of Turnout Tuesday. I'm joined here tonight by Ken Kavula, our dear friend and investment education champion from the mid-Michigan area, a few miles north of Detroit, more than a few, I guess. Good evening, Ken.
Good evening, Mark. It's good to be with you.
And my name is Mark Robertson. I'm founder and managing partner of Manifest Investing, and this is one of those sessions that we've brought together to share with you, I think, a fairly interesting topic. The topic, as is noted there, is of tortoises and rabbits. We talk an awful lot about building balanced portfolios in clubs and our individual investing efforts. And for every blue chip that you have, every once in a while you want to have a so-called rabbit, one of those faster growing companies, and they do work together. It's not necessarily a battle or a race. They literally do work together to keep your portfolio in pretty good shape. And in the background there you see that is definitely a haystack, and the needle in the haystack is certainly true. We go through a lot of smaller companies this time of year looking for investable or actionable opportunities, and that's what tonight's session is all about. So we've been having some fun, so I thought tonight we would give you an update and just kind of kick around a couple new names and again reinforce this notion of you really should have some excellent, smaller, promising companies in your portfolio. Did you have anything you wanted to add to that, Ken?
Well, yeah, I think what's so nice, Mark, about searching through haystacks looking for these needles is that during a lifetime of investing, you don't have to find more than 4 or 5 of those needles that really work out for it to make a significant impact on your total portfolio for a large number of years. And I'm talking 30, 35, 40 different years. Those needles, if they end up being companies like Cognizant Technology or Electronic Arts or Dollar General or any of the other small companies that my wife and I have discovered over the years, they turn into really good high-quality medium companies and then really good high-quality large companies, and they give you a wonderful, wonderful return, highly surpassing that 15% that we seem to be aiming for to double your money every 5 years. We own Cognizant Technology. We've owned it for over 20 years, and our basis in that stock is 14 cents a share. Considering that it's now trading up around the, I don't know, mid to high 70s, that's a pretty nice return over a 20, 25-year period.
Yeah, once again, I'm available for adoption. And
okay.
Yeah, and the one that comes to mind in the last couple of years that we've experienced, well, actually a couple of them, BioReference Labs a few years ago. Many of our community indulged in that and have had a pretty good run with that. But a couple of years ago, we came across Universal Display, ticker OLED, and that has just done dramatically well here over the last 3 or 4 years. And again, that type of discovery can be quite powerful. So that's what.
And in the last 3 or 4 years, you and I have been touting unknown stocks at convention. We don't only talk about these kind of stocks, but they're the fun ones sometimes to talk about. And Illumina comes to my mind, being a $70, $80 stock when we first started to talk about it. Now, 2.5, 3 years later, it's trading in the high 200s. And when you can find that kind of a needle in the haystack and then just ride it through its explosive growth stage as the company matures, you just don't need a whole lot of them in order to have a portfolio that can make you very comfortable.
Yeah, and I kind of wrestle with the notion of whether it's a rabbit or a needle, because when I'm rustling around in the haystack, sometimes I think the needles are moving, much like a rabbit might run around.
Could very well be.
So the rabbit thing makes sense on a couple of different dimensions. So let's go ahead and get the bookkeeping out of the way here. Get the legal beagles happy. Again, we're going to talk about real stocks tonight, probably more than usual. And this is our reminder that no investment recommendation is intended. Please do your own audits, your own studies. The stuff that we kick around here and show you is for illustration and education. It's education and methods that are time-honored and have been used by people who have participated in the modern investment club movement for the last 70 years or so. So that's what we're literally going over. And we'll try to be careful and tell you when we have one. Ken likes to celebrate them, as you just heard him celebrate Cognizant, and that's perfectly okay too. If you want to be added, or if you have a friend or family member who wants to be added to the reminder list for these educational sessions, including the roundtables, you can drop a note to ncavula1@comcast.net that you see on the bottom of the screen there. That's Ken's significantly better other half, Natalie. ncavula1@comcast.net.
Nat's guest list, Mark, just surpassed 1,000 people. So we're now reminding over 1,000 people every month about our roundtable programs and about our Turnout Tuesday programs.
Very cool. You guys actually show up when you register. It's kind of fun. All right, Ken, why don't you go ahead and take this one? This is the background on how we got started doing this.
Well, the Forbes Best Small Companies, as far as Mark and I are concerned, go back quite a ways, maybe 15 or 20 years. He and I have been focusing on this list when it came out. The traditional time of the year for that to be published in Forbes magazine was right at Halloween. So it was a trick or treat for us older guys, especially us guys that were interested in stock investing. That list was published for 36 years running in the magazine, but about 3 or 4 years ago, Forbes decided that they weren't going to publish the list anymore. What they did was they changed to a list of the 100 best private companies. And for folks that want to invest and that want to invest relatively small amounts of money, investing in a private concern just isn't an option. So that list suddenly became a non-starter for us, and Mark and I decided, well, let's try to continue the idea. We don't necessarily want a list of 200 companies, but maybe we can search through our databases and search through information and beg, borrow, and steal ideas from anybody that we can think of. And maybe we can come up with a list of what we think are the best 30 or 40 or 50 stocks. We decided to stick fairly closely to the same criteria that Forbes was using, and Forbes was very open about their criteria. They published it at the start of the list. They said that to be a small company, the revenues had to be less than $1 billion. Well, we've kind of said that that's a really good number to consider, but we're not being obsessive about that $1 billion. If the company's just a little bit over, we're still going to treat it as a small company, especially if its growth rate is up there, above 12, 13%. But $1 billion is the place where we start to consider whether or not we want to keep it on the let's consider list. We wanted sales growth in double digits, so we wanted that sales to be growing at least at 10%, and we would prefer the sales to be growing even higher than that. We decided that we did not want to go for micro companies, for really, really small companies. So we said at the other end of the scale, let's keep revenues greater than 50 million. And that was pretty easy to do. But again, if we found a really great company with really great growth characteristics and the revenues were only 40 million, we weren't going to leave it off the list. We were going to let it compete with the larger companies and see what happens. So we're not obsessing about any of these values. We did want to keep the stock price above $5 to keep us away from the pink sheets, to keep us away from the penny stocks, to keep us away from trouble that exists with some of these really, really low price stocks. We were going to ask that they be best ranked by the Forbes criteria, and we had to decide what that meant in our own database, and I think we'll get to that in just a moment. And because of the way that we're doing measurement of growth and everything, most of the time Forbes said never, did they include an asset-based business from the financial sector? And that's finance talk for no banks, no insurance companies, nothing that's measured by book value growth rather than by sales growth. And again, we've tried to stick with that pretty closely, but if we find a bank that's growing fantastically, we might just put it on the list and make a note that we've included a single bank or maybe two banks or maybe a single insurance company on the list just for you to take a look at. We published this list on the 31st, and this is the 16th of the month, so we have about 2 weeks left now for us to polish the list and finalize the names, but we've decided that we're going to give you a sneak peek of where we're at this moment. Even from our initial discussion yesterday and this morning until tonight, things have drastically changed. If you didn't watch the market today, the market was up, depending on which index you were looking at, anywhere from 2.5% to 3% or more, and that really tumbled our list around. The slides that we've prepared show before today. So there's going to be some movement, and there's going to be some stocks drop off our list, and there's going to be some stocks that are added to it. Here's the history of our experience with the best small companies list. And we started taking it pretty seriously back in 2006. That's a lot of years ago, Mark. You know that?
It really is.
I didn't realize we had done it for that long, okay?
There's actually a little before that, too.
The red bar, folks, is showing the way that up until 2015, the way that our choices from the Forbes list performed, and the way the general stock market as measured by the Wilshire 5000 performed. And you can see that many times that red bar surpassed that blue bar. Many times these small stocks coming from this Forbes list were outperforming the group that included small, medium, and large stocks. Even in that terrible year of 2008 that shows negative, you'll see that the small stocks did better relatively than the Wilshire 5000. That really means they lost less than the general stock market did during that particular terrible year. Now, we've been putting this list together. Our work starts in 2015, and our list is shorter. It's not 200 companies or 100 companies as it was back in 2006, 2007. It's only about 40 or 50 companies, but you can see the outperformance relatively compared to the Wilshire 5000, and you can see that in the most recent year, and it won't close until October 31st, 2018, 2 more weeks to go yet, but you can see that the performance of the small stocks on our list as an aggregate was over 30% compared to the Wilshire 5000, which is just a little bit under 10% right now. So I like that last sentence at the bottom of the slide in the box with the cream colored background, okay? The average annualized return from 2006 to 2018 was 16.5% compared to the 10% for the total stock market. And I've been traveling around for years now, and I keep saying, George Nicholson knew back in the 40s, he knew that the average for the stock market in history, from his point of view, was around 10%. And you know, that number just hasn't changed very much, even in recent history, even during a period of 10 years, or 12 years in this case, which includes the Great Recession. So that 10% over long periods of time seems to be holding pretty great, pretty decently, the same number that Nicholson based all of his investing theory on, the same reason why we have as a long-term goal to reach 15%. Nicholson's goal was so elegant, it basically could be stated in one sentence: beat the market by 5 points. And for him, A 10-point average meant you wanted to do around 15. All the other stuff that's grown up around that number was marketing done by our association after the formation of the association, but that 10% number has held, and it's held real nicely over long periods of time.
Well, it really is kind of fun to have moments like this, because I look at this and, I look at these last 4 years where Forbes orphaned us, left us on the curb in the cold rain with the job to do for ourselves. And what we basically have done is kind of refined it. And when I say I think we might be doing it better, that's what we mean by the right-hand side. I think we look at the world of investing opportunity through the eyes of George Nicholson, and recognize quality and excellence in management when we see it. We try to pursue that, and doing that, I think, has led to those 4 bars. Now, again, we can't exactly get too carried away, but those are 4 facts. And in fact, I do have an apology that I did jinx us a little bit. Kind of seeing how it's championship season for baseball, there's an old tradition that when the pitcher is like 7 or 8 innings into a game and it hasn't given up a hit, you don't talk about it, and you just don't bring it up. In fact, when he goes in the dugout, his teammates won't even look at him, because he has to go back out there for the 9th inning and finish it off. And a couple weeks ago, I bragged a little bit, and I pointed out that our year-over-year performance was at that time 49%. Literally up here, guys. The bar was up there. And, well, this recent correction kind of took care of that and knocked it down to 32. Now, as Ken said earlier, we went from 32 to 36 today alone. So we bounced back up. The market only came up 3%. We came up over 4%. So hopefully we'll get a strong final 2 weeks of October while we're doing our shopping. But the rest of the agenda tonight is basically show you what caused that performance and go looking for candidates for this year's, and basically share that work in progress.
I will tell you, Mark, though, I don't think there's anybody in our audience that wouldn't settle for 20%. So the fact that this is doing 32 or 36 or 38 or 42, that's great. It's terrific. But the fact that it's beating the Wiltshire by as much as it is, that's, I think, the really important message that we want to get through.
Yep. And we'll be pretty hard to tank enough to lose at this point. So that's why we say we've won 10 out of 13. I shouldn't have said that, because that's just bringing the investing odds down. Here are the 10 companies that for the last 11 and a half months have actually contributed to that performance. You can go ahead and read down the list. You'll see some fairly unusual or obscure names and some community favorites like Mercado Libre, which has been hit pretty hard lately. Ken and I both have kind of a hard time getting our whole thought process around BJ's restaurants, but hey, BJ's is doing it. BioVeritab was bought out at an 85% gain just a few months after last year's list. I'll show that to you here in a second. But again, these are all very strong contributors this year to that 36% as of tonight performance. And
I'll tell you a habit that I've had for about 8 or 9 years, Mark, and that's dropping money into the number 1 stock on the list when it was Forbes and the number 2 stock, just as part of my non-traditional investing. Folks, it's not based on an SSG. It's not better investing philosophy. But remember, Nicholson told us that we can put 20% of our money, if we have mature portfolios, into non-traditional stuff. You can have a little bit of fun with some of your money. After all, what's it for? So for the last 7 or 8 years, I've been buying a small holding in the number 1 stock and the number 2 stock. And I will tell you that last year, our number 1 stock was Cambridge, and that's on the top 10 list. And our number 2 stock was Viva Systems, and that's on our list as well. So I very rarely have had two losers when I buy 1 and 2. Sometimes I only have 1 winner. But for most of the time, for at least half of the time, I've had 2 winners when I've played that particular game with some non-traditional kind of investing.
Well, in that case, you're buying dinner.
I certainly will next time I see you. Okay.
Well, here's the wonderful thing that happens with many of these type of companies, and we love to get out of the way and let the money flow to us when we get these opportunities. BioVeritiv, I think that was a spinoff from was it Biogen? It was either Biogen or Abbott. I
Yeah,
can't remember.
I'm
It
not.
was a spinoff, but
Yeah, I'm not
anyhow,
remembering. Yeah.
we picked it last Halloween, and it proceeded to gain 85% in about 2 months. So that's always fun when one of them gets taken away. And then we can't quit without talking about the ones at the bottom of the stack. Now, the neat thing about this year's list is very often we'll find, again, we take $100 and invest it on Halloween. So in the case of Nutrisystem, our weakest performer, it's actually lost $32. Well, in other years, that bottom stock has been down as low as $20 or $30. And so these are actually all pretty good. These are all within, with the exception of Nutrisystem, within 20% of that original $100 investment. And the thing we do like to point out, because this just bears out, kind of like Ken was talking about when we first got started, the gains from the top two companies more than offset the unrealized losses from all of these. And that's just phenomenal when you think about that. That's the type of thing we have seen happen year in and year out.
Yeah, Mark, we have a couple questions. Ram wants to know how much has been invested in each stock, and I think you just answered that. There's an imaginary $100 placed in each one of these stocks at the beginning of the year on November 1st when we start the accounting practice. And then he wants to know, is this a real portfolio in an investment account? Ram, maybe we're silly for not making it a real portfolio because it's done quite well over the years. But no, this is not a real money portfolio. This is a portfolio of ideas for the folks to take a look at, for our communities to examine, to study, and then decide which ones of them they think fit into their particular portfolios. We're also getting a note from Nick Strategos out in Pittsburgh Way, and Nick says, yes, BioVeritiv did come from Biogen.
Okay, that's what I thought I remembered. Okay. Yeah, I have an account at Robinhood, and I've been tempted to take and put 100 into each one of the 20, and maybe I'll do that this year just for kicks. If I can.
Well, talk about jinxing it, Mark.
I hate to think what the bars might look like if we actually did that. Oh well. So anyhow, there's a pretty good spread of the companies, and I thought I'd spend a moment just kind of putting it in context of what we're actually doing here. And what I did is I took the 2,400 companies or so that are in our database that we cover, and just made a distribution profile ranging from the lower growth rates down here at the left-hand side up to the upper growth rates. So what you're looking at is that distribution. It's a bell curve. The average sales growth forecast for most companies is somewhere in that 7% range, right towards the top of the bell there. And the yellow companies are just simply companies that are growing lower than the inflation rate. Or the other way I think about it is Nicholson one time was asked, is there any point in at which you become less interested in a company? And his answer was, yeah, when the growth rate gets down around 3, maybe 2% or less. He's less interested in that certainly as a core investment. Might be looking for some special value situations. But again, we're talking about basically non-growth companies to the left. Those blue bars, those are our blue chip stalwarts, kind of core companies, and they make up pretty much the majority of companies growing in that 4, 5, 6, 7% growth range. The green bars that are shown here from 7 to 11 or so, those are the more the medium-sized. I think of them as workhorses. You can do excellent making sure that you're invested in those. And again, most of our portfolios, we try to keep between a third or 50% of our portfolio in these type of companies, right down the middle there. And then the companies that we're talking about here tonight, companies growing at least double digits, we're going to campaign for maybe 11.5 or 12% and above. And you can see they taper off. So we're basically shopping in that field of red that you see here on the right. Again, looking for companies growing at those type of rates with exceptional management characteristics and high quality ratings. And again, there's the rabbit. If you want to think of them as red rabbits, I certainly do. They're a lot of fun to chase, and once you get a hold of them, they're a lot of fun to own. But not for the faint of heart. And of course, that's a
I, pro-
nod to the Red Chip review there also. Go ahead, Ken.
I promised I'd ask this question to our audience, Mark, so I will. Is there anybody that frequents casinos? And if you do frequent casinos, are blue chips at a table a standard color that means large denominations? And are red chips at a table or at a casino standard casino to casino that talks about smaller denominations? I'm just wondering if that blue-red idea in casino chips is true, or if that's just something that somebody made up and told me. So if you know the answer, type it in the box right there, and we'll share it with everybody else then. Okay?
We'll see who's honest out there. I actually don't know. I don't know enough about casino chips to answer the question.
I've actually been in a casino only about 3 times in my life, so you're not going to find the answer from me either. So.
But again, this comes with that reminder that, again, companies during their life cycle tend to move from the right-hand side to the left-hand side of this chart. And it's something that T. Rowe Price, that's a guy, that also a company, but T. Rowe Price was one of the fathers of growth investing, and that's his quote there from Wayne Thorpe of the American Association. And again, he thought that it was a pretty good idea to find the companies when they were smaller and growing rapidly and heading for maturity. And again, we'll just there's our quick reminder of we're talking about companies that are, somewhere down the middle there towards the left-hand side, breaking through, actually making profitability. We're going to actually show you a couple case studies tonight of companies that are pretty close to this point in their life cycle, just breaking through and making some earnings. And the up, straight, and parallel part of an investing life cycle is right here. And we like to have enough of these type of companies in our portfolios also. So we're talking about the combination of healthy tortoises and exciting, promising rabbits. Any question on that, Ken?
Well, I just will repeat to folks that haven't seen it before, the significance of that fishbowl right there is that the growth many times of a company is only limited by outside factors, just like if you put a goldfish in a small bowl, it stays a relatively small fish. You give it a lot of room to swim around, however, and it becomes a pretty good size specimen. So if we give these companies enough fertilizer and enough space, then we get these explosive stages, and that's the place to find them, where you have the up arrow pointing when they're nice and small, and then you want to ride them. And that's stage 3, stage 4. That can take as much as 20, 25, 30 years, or it can happen in as little as 2 or 3 years. A lot of it depends on what the product is, and a lot of it depends on the type of management that's dealing with the company. I think there's companies out there like Apple, for example, that kind of has reset itself 2 or 3 different times. So it's reached that stage 4 place and then decided it was going to reset back to the beginning of stage 3, and it was done by looking at completely revolutionary products to make that happen.
Yeah, Intel is another one that gets credit for continuously reinventing itself. I do get the question when I'm teaching classes, is that ugly right-hand side inevitable? And the answer is it happens to many. I mean, we saw the disappearance of Sears just here in the last couple of days. So it does happen to some companies. By the way, Sears was the Amazon of its time. Think about that. Sears was the Amazon of its time.
We can also point to General Electric. Where is GE right now on this graph? I would love to believe that it's up there and it's going to follow that blue dotted line to the extreme right, but I think there's an even Steven chance that it's going to follow that other blue line that's moving down or back down towards zero and non-profitability.
Yep, and that is painful, and it's unfortunate that does happen, but it is kind of a circle of life thing. There are some exceptions, I think, of companies like Hershey's. Hershey's will probably continue on in that section 5, stage 5 mode. They could stay there for a very long time because that's a pretty reliable demand profile. Hershey's.
And while the growth in stage 5, Mark, is not explosive, there's still good solid growth going on in that mature stable phase. It's just not the kind of growth where you're going to make as much money as you're making in stage 3 and stage 4.
Yep. When your tortoise slows down, you need more rabbits.
Yep.
All right. So here, as Ken, let's just review. As Ken was suggesting earlier, we tried to stick to the Forbes criteria. But the thing we've discovered over the years, and I was a skeptic when I first met Ken Kavula, and he insisted on this, it is possible to find small, promising companies that are growing rapidly that are up straight and parallel. And that is such a powerful thing to get your arms around, that they're out there, and you can speculate with some of the, we're going to talk about a couple of them tonight, but again, you can build a pretty solid core of excellent small companies sticking to charts like these. So again, just to reiterate, we're looking for companies with double digit. We'd like to nudge that up a little bit, a percent or two. And we don't believe in these red lines. This 1 billion level threshold, it's not a red line in the sand or anything like that. You know, there is some latitude if we have an exciting company that is just over that, maybe at 1.2 billion. We're willing to go there, and we will stretch it the other way too. If we find an exceptionally well managed company and one that you're going to see a simulations plus, we're willing to dip below that $50 million guideline for a very well managed company. You've heard me talk about Chuck Allman and his fantastic performance with the Growth Stock Outlook newsletter over the years. I've covered this in sessions before. He used to have a couple of these companies in his portfolio. One of them was Mocon. It was an industrial, almost like an early Fastenal factory type company. But again, it was like 20 million in annual sales, but just a very, very ownable, good stewardship type company that delivered fantastic returns to Chuck and his investors over the years. So that is possible. We do want to avoid the penny stocks. We don't exclude the asset-based business, but they just don't generally make it very often. I think Signature Bank made the list last year, and we'll see if any make it this year. But again, best, we define best the way that our community defines it through the eyes of George Nicholson. We want excellent quality, and we want a superior return forecast. That's what we've been doing for 4 years. That's what we'll continue to do this year. Any comment or question to that, Ken?
Well, yeah, I just want to comment on those 3 pictures that you had at the top of this slide here. When I first met this very bright young man from Better Investing that was writing the back page of the magazine on a monthly basis, and I told him that one of my passions was finding small stocks to invest in. I still remember the statement that came out of his mouth, and that was that you can't really find small stocks that do what Better Investing wants you to have them do. And I just kept my mouth shut because I didn't know
Was I
him
sober?
very well. And you were sober.
Okay.
But I didn't know him very well, and I figured he was smarter than I was because he was writing for the magazine. But I did make the statement as we learned to deal with each other, and then we started traveling together. I started saying to him time and time again in the car in the early days of travel that you needed to expect as much out of your small companies as you expect out of your large companies. I never had the audacity to say that you could find them that were up straight and parallel, but I knew in my heart that you could. And eventually, it didn't take very long because Mark's a really smart man, but he came to the realization that what we were talking about was the absolute truth, that if you have high expectations, you can still find great small companies. You just have to work at it a little bit harder because they're not the companies that everybody's talking about in the public eye all the time. So here's 3 examples of the kind of graphs you want, and frankly, those could be graphs of medium-sized companies or large companies, or in this case, they're smaller companies, and I'd be happy with them no matter what size they are because of the consistency of the sales growth and the earnings growth.
Yep, they're out there, so that's what we go try to find. Here's where we go looking, and we're going to cover a couple of these here tonight. You guys have seen some of this stuff before. This is how we go hunt down the rabbits or the needles in the haystack. Um, some of our favorite places to go, I'll start towards the bottom, are you guys. Um, we get submissions virtually every week, especially here over the last couple of months, of ideas of fairly local companies. I think back over the years to discovering companies like 26 out of Pittsburgh or Mesa Labs out of Denver. And a lot of times those ideas will come from you guys. Just, we'll note them in your investment club portfolios, or you guys will send us a nudge. We are going to look in some other places like the shadow stocks at the American Association, the Red Chip Review, which covers micro caps and smaller companies. David Gardner as a source of ideas, and the hidden gem seeking fools at the Motley Fool. Chris Jenner has a stellar track record. We're going to take a closer look at him, and then we'll go to mutual funds, and we'll start with that demonstration here tonight. Mutual funds that have demonstrated, in many cases for decades, stock picking prowess when it comes to the smaller companies. Ken, why don't you go ahead and share any thoughts you have?
Sure. One of the places that I scour, especially around this time of the year, is the Value Line Small and Mid Cap Edition. I figured that the Large Cap Edition, we have it covered pretty well. Almost any company in the Large Cap Edition that has earnings is already included in the Manifest database. So I'm looking at the Small and Mid Cap Edition, and I don't look at it page by page, but I go through the summary. And on the summary pages, they'll list all the stocks that are ranked 1 for performance, all the stocks that are ranked 2, all the stocks that are ranked 3. They'll give you a couple of sample portfolios of what they think their best ideas are. And they'll talk about some of the highest ranked stocks in the highest ranked industries. All told, they'll give you the top quarter or third of what they consider to be the best from the entire survey itself, and the entire small and mid cap edition. So I'll go through those and I'll put the tickers in, and I'll look at the growth lines real seriously. And there's some terrible ideas in the small and mid cap, or there's some ideas where there's no earnings at all, and there's some ideas where there's only 1 or 2 years of history. So for every one that I finally give to Mark to add to the database, I probably reject 10 or 12, but it's a way for us to add another 40 or 45 names to the database on a fairly regular basis. And I would say that happens maybe twice a year. So that's one way that we keep the database. We keep the small stocks moving into the database. It's also a way that we discover some of these early phase kind of things that we were talking about on that growth screen. I'll give the name to Mark of a stock where they have 5 or 6 years of beautiful, consistent sales, and where they're just maybe moving into profitability for the first year, or maybe 2 years, or maybe 3 years. So I'm not looking at 2 sets of parallel lines, and I'm not looking for that stock to make our small companies list the first time I give it to Mark to put in the database. I'm looking for it to be there, and then we can watch it grow. We can watch what it does year over year. Its quality rating will mature. Or maybe it will disappear. Maybe it'll be bought out. Maybe it will go bankrupt. There's all kinds of reasons why some of these stocks disappear as well, but it's a great source of ideas. The other thing that I do is I use the new SSG Plus tool for better investing. That screener in SSG Plus is absolutely powerful, especially because I can make it spit out lists of complete industries, or I can make it spit out lists that are tailor-made to look for the same kind of stocks that I'm looking for in this small cap discovery. Once I get that long list of 50 or 60 or 100 or 200 companies, the tool allows me to skip through those one at a time, checking out the visual analysis, and I can literally go through 50 companies in maybe 20 or 30 minutes, all I'm looking for, it's not rocket science, folks. All I'm looking for is up, straight, and parallel. And then I'm looking for names that we don't cover in the manifest investing database so that we can add it to the database. It's real simple, basic grunt work, but it gives us a nice steady stream of newcomers to the database, and that's what you need to have if you're looking for small companies.
Okay, so let's go ahead and talk about these sources of ideas. And here's a look at the mutual funds where we will go and literally hunt for ideas. These are ranked by their 10-year performance track records from highest return to lowest. And you can see that the Wilshire 5000 is in here because that's basically, we're saying our default condition is to just invest in the total stock market and go golfing instead. So we want to find basically the people that have routinely outperformed that and then see what type of ideas they might have for investing. So we'll start up at the top of this list and begin looking for actionable ideas as we work our way down the list. And again, this is a pretty powerful slide. We're basically looking at a cross-section of people who know how to navigate the minefield of small company stocks, those rapid growers, and have done it very well over an extended period of time. A few have slipped, and we will pay a little bit less attention to them this year. And the other thing I like to point out is, if you had a list of just the small mutual funds, the small company mutual funds, it would be several hundred companies in length. And notice that there's only a little over a dozen above the gray line there. So if you happen to be in an investment club that has only, and I'm saying only in italics and air quotes, a 3 or 4% relative return to the market. In other words, you're only beating it by a couple of percent. Even if you're only beating it by 1 or 2%, you're in rare company. I mean, look at this list. Again, keep in mind that there are a few hundred below here that fail to keep up with the total stock market. So again, this is our list. So that's what we'll go ahead and demonstrate for you here really quick. This happens to be the number one company, Prime Cap Odyssey Fund. The ticker symbol is POAGX. And what I do is I go into the Morningstar database, and I've actually taken to sorting by this first bought in reverse order. So it gives me what they have bought lately. And what I'm looking for is companies that have been bought in the last 3, 6, or 9 months, and see if there's something that might pique our attention. And you can see the ones that have been added that are brand new to this portfolio have that starburst icon to the left. And you see a few names that we have at the top of this list. You see a few names that we have seen in a number of portfolios. In fact, Five Below is one of our top performing companies, thanks to Nick Strategos out of Pittsburgh in the Roundtable portfolio this year. So that's on this list. So again, you can go down this one by one, and kind of like Ken was just saying, look for up, straight, and parallel with powerful potential. And companies that we've added from this list are Enlight, ticker symbol LASR. That is just what you think it is. It's a laser company. We've seen a lot of laser companies here lately with Coherent, and Ken just brought another one to the
IPG Photonics.
Yeah, IPG Photonics. So there's been a number of laser type companies, that type of companies added to the portfolio. Glaukos, you'll see, is actually going to show up in a couple of the lists that we look at. That's a glaucoma company that is now in issue 1 of the Value Line Standard Edition. Ingevity, some interesting companies. So as you look those over, those could be sources of ideas. Another place that we've turned in the past and has been very rewarding, generating a number of ideas, is Chris Jenner. Chris Jenner, he runs Rock Springs Capital Management now. Chris used to run the T. Rowe Price Health Sciences Fund, one of the top performing mutual funds in history, for about a 20-year period, 16 or 20 years. And he's taken to this Rock Springs Capital Management. It's a hedge fund, but you can still go to places like this holdingschannel.com and actually look at the stocks that he's pursuing. Now, his specialty is healthcare. He's always out there looking for these telemetry type companies that might be on the path to discovering the cure for cancer. Could be just companies that are very well managed in healthcare administration. You can see that United Health Group is one of his top holdings. That has been one of his top holdings for the last several years, and he began picking that up before the ramp up in price here over the last 3 to 5 years. So he saw something coming in that aspect of the business, even with all of the legislative challenges that are faced by the healthcare industry. So again, you can look down that list, and it runs for a couple of pages. You can focus in on the biggest and new positions, and those are the ones that we always run through the mill, run a quick study on. Like I say, in previous years, we typically find 3 or 4 study candidates on this type of list. In this case, many of these companies are very early stage. And what I mean by that is companies that have barely any sales, like maybe 5 million, maybe 10 million, in some cases 1 million, and no earnings. You know, those type of companies where you're looking along the earnings line and it's minus $4, minus $5, minus $3. There's a bunch of those type of companies, but again, he invests in early stage quite a bit. So none of these really jumped off the page this year for Chris Jenner, but it's a great source to monitor for some fairly interesting ideas over the long term.
And we should make it clear, Mark, that these are not all small stocks. Notice that last one on the boxed-in stocks that you have, it's McKesson.
Yep.
And McKesson is a really, really large stock. Intuitive Surgical on this list, a pretty good-sized stock. United Health Group, another pretty good-sized stock. So these aren't all smalls, but when you find new ideas, many times they are small.
Absolutely. All right, let's take a look at another fund that's been quite a strong performer over the years. Price. This is the T. Rowe Price New Horizons Fund. Actually own some shares of this in one of the retirement accounts. PRNHX is the ticker. And again, same thing. I go in and click on the bought column, reverse sort it so that we can see what has been bought lately. You see all the starbursts over here on the left. There are several smaller companies on this list. We see Glaukos again showing up here. Some fairly early stage companies among these, but we did manage to add GCP Applied Technologies, tickers GCP, and Colliers International. Glaukos has already been added, but many of these also are fairly new stage and didn't quite make the list yet for us. Over the years, you've heard us talk about year in and year out, Brown Small Company ends up at the top of that list. Now, I love the name of this fund because it doesn't say small cap. It says small company. These guys tend to think like us. You guys have heard us talk about them. The Brown Capital Management people, they literally came out of the investment club movement, Eddie Brown, back in the late 1960s, early 1970s. Kind of a friend to us over the years, but again, they tend to think like us, and some pretty neat characteristics in terms of how committed they are to their types of decisions. One of the things that you'll notice when we're looking at the companies that have been bought by them is it doesn't take very long, and you notice we're going back a couple of years. So they don't make a lot of purchase decisions. They make them with conviction. Fans of the roundtable will remember that I presented alarm.com at the roundtable, the live roundtable at the National Convention. You can see that has done pretty well this year, up 27.6%. And the only stock that they bought in the last 6 months is this Q2 Holdings. Q2 Holdings, the ticker symbol is QTWO. And we've actually added that to coverage. We'll take a closer look at that in a second. But again, these guys think like us. They're committed to their decisions. They have very low turnover, 10 or 12% over the long term, and can be a very powerful source of ideas of investing opportunities to study. Here's a look at Q2 Holdings. Again, early stage, not for beginning investors, but for, as Ken was saying, if if you want to be a little bit playful with this sort of thing, this is the type of company, in my opinion, that an experienced investor can make a lot of money on. This is a company that is in the business of providing cloud-based information systems and technology to regional banks and insurance boutiques. So they've got a very large field of opportunity. If you look at the list of regional banks, I swear we cover about 2,000 of them. That may be a little bit high, right, Ken?
I think a little bit, but
it seems like we cover a lot of regional banks. So there's a lot of people for these guys to sell to. So they're a technology company that comes in and helps banks with basically their online presence. And a lot of times those banks out in the sticks, I grew up out in the boondocks, they need a little bit of help. They're not all blessed with the IT staff of a JP Morgan Chase type company. So these guys are out there in the sticks. As Ken said, might they be kind of a early stage Jack Henry? And I think they could be. Kind of a compelling story. And I consider them to be vetted, absolutely vetted by a company like Brown Capital, small company. Again, they've got a very strong track record. And what we're looking at here is a company that has a very strong sales trend over the years. The price is tracking it pretty well. And they're just now becoming profitable. So think back to the fishbowl that we talked about a few minutes ago. They're definitely at that point where they're breaking through and beginning to make a profit literally within the next year or so. So it's a very key moment in their development. But literally the guys from Brown Capital have to be sitting there looking at this extremely powerful sales trend that has been building, the culture that's in place at the company, strong sales. If they can, basically, if you could extend this visually, can't even really do an SSG on the company, but if you could come to expect profit margins, for these guys are a infrastructure software type company, in the 15 to 20% range. You can see that we use 15 here, along with a PE ratio that's not exorbitant, say 30, 35, or 40. We're looking at fairly promising reward potential. And that actually is fairly conservative when you stack them up versus other companies in the infrastructure software industry. So again, if they deliver on what they seem to be on a path to deliver, and that's what Brown Capital sees, this one could be some fun. I might actually dabble with a little bit of personal money in this one because I have considerable faith in the small company stock selection capabilities of Brown Small Capital. Again, very little turnover, a whole lot of conviction, not a whole lot of stocks. You can see only 36 in the total portfolio.
Can we take a timeout for just a moment, and can we go to the Manifest Investing website and show folks where they can see these portfolios first of all, for the Forbes list and later for our list, where they've been maintained? We're getting a lot of questions on the look of some of these portfolios 5 and 6 and 7 years later. And what's nice about what we're doing is that we maintain the dashboards for these lists that we put together 3 years ago, 5 years ago, 10 years ago, and you could see what the stocks have done with $100 invested, and then over the period of time that the dashboard happens to deal with. Could you go to the Manifest site and just show them where they can find that, Mark?
Sure. If I can remember how to navigate here. Okay, so what you're going to want to do if you go to the Manifest Investing site, and again, if you're not a subscriber, send me a note. I'd be happy to give you an extended test drive. Just send it to markr@manifestinvesting.com and be happy to take care of you. But if you want to go into the published dashboards, just click on More. Again, that's from the home page, and you can actually see best small companies from last year and the year before that right here. So let's go back and look at the year before last, and you can see that Align Technology is one example. $100 invested in Align Technology a couple years ago is now worth almost $400. You can see going down the list, these are the companies that were actually selected back a couple of years ago for our best small company list. So again, if you go into the published dashboards, you can look into those. Here's the list of small company funds that shows you the prime cap and the new horizons and the brown small capital that we were just talking about. Same type of concept. And then a little bit further down, let's go back to
Well, there they are right there, Mark. The Forbes 100.
let's go back
Best small. Yeah.
Yeah, I want to go back and look at the carnage of 2008.
Okay.
Some of these need to be updated, but going back in that amount of time, here's Middleby. That's a company that's been a recent favorite by Ken at the roundtable. $100 invested in this about 10 years ago is worth over $500 now. What was the big year was 2007 though, wasn't it? The tough year.
No, it was 2008, I'm pretty sure.
Well, one of our early discoveries, Neogen.
Yep.
This is 11 years ago. Check out that number. And again, we consider Neogen to be kind of a poster child for up, straight, and parallel amongst the smaller companies.
Now, we have Ram Mark asking the question, well, he knows you can make a lot of money. He wants to know how much could you conceivably lose? Well, the answer is just like anything else in the market. You can lose the whole thing. They can go bankrupt. And these dashboards will also show you the ones that have gained the least. Remember, at the time the dashboard was created, every single stock started with $100. So if Mark were to sort this one by value today, he can sort all these columns. He sorts it by value up there at the top, but he's clicking on it. Then you can see that one of these stocks since 2007 has gone from $100 to $32. W&T Offshore, I think that's probably an energy stock of some sort. And today, its potential return is pegged at negative 16%. In other words, not a very good investment. But
it's a train wreck.
If you're going to have a train wreck, you need something to balance it with. And in this particular year, it was balanced with Neogen that went from $100 to $1,100 in that same time period.
So we do keep track of those, and people do publish the Forbes and the Fortune lists. Let's go ahead and grab the Fortune list for this year. This is the one that Marie Frank gave us that Ken was whining about a few minutes ago. Marie, this is from September of this year, so Malibu Boats is actually up from 100 to 133 already. But again, going down this list, the process of making sure we were covering all of these companies, in the process of doing this for us, Marie forced us to add coverage to about 15 companies. And just a real nice place to go. And again, if I'm looking at one of these type of lists, I very often will sort it by best quality first, and then search for companies that are likely to be in the buy zone. Higher return forecasts. Does that cover pretty much what you wanted to cover, Ken?
I think that covers the questions that people were asking. Sure, Mark. Let's go back to our prepared slides.
So
yeah.
those are there if you want to tinker with them. All right, so here are the 20 that are currently in position. These will be challenged over the next couple of weeks by companies that we discover as we continue down that list. We look at the red chip and we look at those other top performing mutual funds and receive ideas from the audience. And I predict that 5 or 6 of these will probably drop from the list. They will move around a little bit as their stock prices change and they get updates here over the next couple of weeks. But this is the type of companies that are showing up on the list at this point in time. And you can see the numbers on the far left are their position in the top 40 best small companies last year. So you can see that there's a handful, about 8 companies that are repeat selections from the 2018 list and are headed for the 2019 list. So some good clean fun there, and some.
And the red number symbol means what, Mark?
Those are in the S&P 600.
Okay.
So they're in the S&P grouping of small cap stocks. Okay.
we're getting questions. Can people review this presentation and look at these things at their leisure? And the answer is yes. We have a YouTube channel. Look for Manifest Roundtable or Mid Michigan Roundtable. Either one of those will take you to our YouTube channel. And all of our presentations, both the roundtable presentations and the Turnout Tuesday presentations, are available on YouTube. I am amazed that my wife, who monitors this kind of thing, is now telling us that we're getting 400 and 500 hits every month on our more recent presentations. So if you can't come live, go on to the YouTube channel and take a look at what we've done recently. Or if you want to spend some time and review the whole presentation, it's there. And we're not real sensitive when it comes to releasing these things. If you really want a copy of this presentation for your own machine to run at your own pace, the slides, I've known Mark for a long time, and I know that it just takes an email to him and he'll be glad to send you either a PDF of the slides or the slides themselves.
Sure, and we also post the PDF of the presentation in the Manifest forum too. So
yeah, Jennifer wants to know what the asterisks mean on the companies. Jennifer, that just means they're not in the main value line. That's all it means, that there are companies that aren't in the main value line. And you would expect on a list like this that many of the stocks would carry asterisks.
right. A lot of these are up straight and parallel. Now, some of you get the heebie-jeebies from that one, and I understand that. That one probably won't make our list this year. But here's one that did, and again from Marie Frank's contribution of the Fortune 100 fastest growing companies, this was number one for this year. This is Health Insurance Innovations. Again, another cloud-based company, simply in the insurance business. They basically are a soup to nuts, cloud-based business that works with companies like Nationwide Insurance. I believe Humana was one of them. They have some major carriers, but they do the whole thing. Issue the e-insurance type quotes, print your membership cards, your insurance cards, that sort of thing, and all of the paperwork and contract stuff. They take care of that for all these companies. Very heralded company with fairly decent looking picture here. You can see that the sales trend has been pretty strong here from 2012 through the recent past. Again, we're talking about upper teen growth rates, decent profit margins, and fairly normal PEs in the 18, 20, 22 range. And again, you can see a fairly strong stabilizing picture when it comes to the earnings also. Again, fairly young company, a little bit younger than even some of the others, but definitely worthy of study and inclusion in watch lists and that type of consideration.
And Mark, we have a newcomer that spotted the fact that you have dots for 2018 and 2019. You want to explain why you have dots for years that haven't closed yet?
Yeah, what we think it's extremely important, especially with companies like these, to include the 2018, this year and this year plus one. And for some of the value line companies, we have that 3 to 5 year estimate also. We include them in the trend formation. So in the trend formation that you can see here, these years are included. And you can see here, in this case, that's actually tugging down, if you want to think of it as tugging down on the right-hand side of that trend and kind of moderating it. And that's an extremely important consideration, can be extremely important for smaller companies or spotting cyclical type companies. But we embed those future estimates in all the work we do at Manifest Investing. If you're curious about that topic, send me a note. I'd be happy to send you a link to a cover story, which will help you understand why we do that and why we think it's urgently important and why we believe it actually can add a few percentage points to your long-term results. So with that, I think we'll wrap up and maybe field a few more questions. But again, Halloween is what triggers this for us every year. So we're going to wish you happy Halloween. We really enjoy coming up with some of the tricks and treats that accompany these smaller companies, and if you stay tuned here over the next couple of weeks, we'll be out with that final listing the day of Halloween or the day after. And let's hope that they continue to behave as these companies have behaved for the last 4 years. Maybe I'll stay away from buying them just so the audience can enjoy them.
Okay, that might be a good idea, Mark. I'd like to speak directly to all the folks in mid-Michigan or the surrounding chapters in Capital Area or southeastern Michigan, maybe even in western Michigan. We have our Stock Pickers Breakfast coming up in Saginaw, Michigan on November 10th. That's after Halloween, if you can figure out the calendar there. And Mark and I are going to be speaking, and one of the things we are going to be revealing to that audience is the list for 2018-19. So come to our Stock Pickers Breakfast. If you want information on how to register, go to our meetup page or send an email to nkavula1@comcast.net. That's nkavula1@comcast.net. And that's my wife's email. She'll send you a registration form. It's the only time, Mid-Michigan chapter, that we come to you and ask you for financial support. All of our programs, every single program we do is for free, except for this one program. And we hope to make the small amount of money that we need to keep the chapter functioning in a healthy way. So if you can see your way fit to come to the breakfast, we'd love to have you. If it's too far and you feel that we're doing something that's valuable, drop the registration fee in an envelope, send it to us, and tell us we don't have to feed you breakfast. That would be really nice also. But frankly, Mark and I would love to see you and shake your hand. And the breakfast is always a lot of fun. It's always very, very entertaining. And our folks leave with big, long lists of great stock ideas, both from the small companies list and from the stocks that are picked in the upcoming stock contest, which the Stock Pickers Breakfast celebrates each year. Nick wants to know, what's our meetup called? Our meetup is called Mid-Michigan Meetup. If you just start with Mid-Michigan, it'll take you right to our meetup, okay? Ann wants to know, are you only picking U.S. companies? Just found out about an Irish company, Amarin, A-M-R-N. Don't know if it would meet the criteria or not. And to keep it simple, I think we're only choosing companies that are traded on the New York Stock Exchange as a domestic company or as an ADR. I don't think we want to get into the problem of currency. And many times when you move to other stock exchanges, you're dealing in other currencies, and that really conflicts then with what the values of the different quantities happen to be. Mark, do you know if you've heard of AMRN before?
I'm very familiar. It's a very popular company. It's hot in the private investing world now, hedge fund world. I think that probably is an ADR. I'll have to look.
Okay, so if it's an ADR, and we can definitely take a look at it, because then it ends up trading in the United States in US dollars, and that's the key most of the time for us. I'm looking for other questions, Mark. I'm looking for hands in the air. Usually when I say I don't see any more, I get two more coming right up, but I don't see any more questions. There we go. Ann says, oh, it's a comment from Ann again. The stock went up over 400% in September, and it expects to go up more. So maybe AMRN is one to take a look at. If we don't include it, and if it is an ADR, maybe you'll see it in the database, okay? Thanks for the idea, Ann. We appreciate it. That's how we get so many of our ideas. I don't see any hands raised. I don't see any more questions going on. Mark, do you have any last comments?
No, I guess my only comment is I've done this for the last couple of decades, and I really think that it's a powerful potential contributor to portfolios. I mean, we have not neglected this, but I'm questioning whether we probably should even turn up our emphasis on finding these type of companies for our portfolios. I just completed a presentation that I'm going to be giving this Saturday in Washington, D.C., where I basically I'm taking a look at the works of two wonderful founders, George Nicholson from the National Association and James Clunan from the American Association of Investors. And that's kind of the place they end up too, or that you basically want these rapidly growing, excellent companies in your portfolios. Comes as no surprise based on the results achieved by people like Babson and Price and Chuck Ullman with the growth stock outlook. So again, I think it's an area to really dig into. If you happen to be in an investment club that is skittish about the smaller companies, I think the slide that really takes the day is this one right here, where perhaps you can convince your investment club partners that even through recessions, these small companies, that it is possible to find small companies that remain relatively up, straight, and parallel, and they're not all roller coasters, because the rewards are outsized. The potential rewards are outsized, and again, I would just double down on the emphasis of finding these type of wonderful opportunities for your investing experience.
Mark, you want to mention again when you're going to be in the Washington, D.C. area speaking?
Yeah, it's this coming Saturday morning, October 20th, at the Community College in Annandale, Virginia. It's a morning program. It's actually a joint.
If you need more information, folks, go to the DC chapter webpage on the Better Investing website, and they certainly have ideas and maps and registration and all that kind of stuff. I'm going to be in Charlotte, North Carolina on the 27th, speaking to members of the North Carolina chapter and the South Carolina chapter. And if you would like details on that particular event, again, go to the Better Investing webpage, look for either the North Carolina chapter or the South Carolina chapter, and you'll find all the details you need to get to the event and to register for the event. I'm looking for one last question to see if we have anything right here. Mark, Sharon is telling us that AMRN is indeed on the NASDAQ. Okay. And Haney says, how to do a search for small funds on Morningstar. Haney, we just don't have the time in the presentation this evening to show you that, but we've talked before that using screeners is going to be one of our topics for a Turnout Tuesday in the next 3 or 4 times. So make sure you come to the turnout that talks about using screeners. I think that'll fill the bill for you as far as what you're looking at. Bonnie wants to know, are we going to talk about Clooney's book? Mark?
Are we going to talk about Clooney's book? I talk about it on Saturday, yeah. Are we going to talk about it? Yeah, I think at some point, perhaps even the December session of this, Turnout Tuesday in December, we might tackle that as a potential subject. And don't forget, we've got a roundtable a week from today also.
And Mark, the name is escaping my jello brain right now, but the other book that we've been talking about so much, the single word title, can you help me out? Written by the Norwegian fellow. I think we could possibly include that in a book discussion as well.
Yeah, that one was Factfulness.
Factfulness. Thank you.
And for those curious, and we probably will talk about this. We've tabled this for a little while. The James Clunan book is Investing at Level 3. And you can actually find a number of posts in the manifesto.
Bonnie, it's not Clooney, Bonnie. It's Clunan. Okay,
Clunan.
Not George. Okay, but James. All right.
No, we don't want to go down with George Clooney.
All right.
On the book.
So we've covered. Go on, Mark.
I'm just going to spell Clunan's name for anybody that might want to look it up on Amazon. It's Cloonan, and he's the American Association version of George Nicholson.
Okay. No more hands. No more questions. Thank you all so much for attending this evening. Marks, thank you for everything you do for my chapter and for being such a good friend. You're greatly appreciated.
Well, thank you so much, and I hope everybody enjoyed it and everybody enjoys rewards.
Good night, everybody.
Thanks.